Today, yet more Numberwanging, the DFA daily to the 20th of August 2021. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. In today's show, we look at the latest employment data from the US and Australia and discuss the implications, and also highlight that the numbers tell us, well, less than many think about what is really going on. Not least, do people spend less time looking for jobs when the government hands out more support? First, the S&P 500 eked out a small gain in a wild session on Thursday, as strength in techs helped lift investor sentiment a day after the Federal Reserve's minutes signalled bond tapering by the end of the year. The S&P 500 rose 0.1% after falling by as much as 0.7%, and the Dow Jones Industrial Average slipped 0.2%, while the Nasdaq was up 0.1%. Nvidia led the rally in technology, ending the day up 4% after the chipmaker reported quarterly results that beat on both the top and bottom lines. The better-than-expected results were driven predominantly by data center, in addition to strength in professional visualization, they said. Cisco Systems, meanwhile, climbed about 4% after reporting fiscal fourth-quarter results that topped Wall Street estimates, underpinned by strong order growth and growing demand for 5G digital transformation and cloud security. In big tech, Facebook cut its intraday gains to end lower amid further legal troubles after the Federal Trade Commission refiled its antitrust case against the social media company. The FTC alleges that Facebook resorted to an illegal buy or bury scheme to maintain its dominance after failing to develop innovative mobile features for its network. The trade watchdog has called for the breakup of the company. After failing to compete with new innovators, Facebook illegally bought or buried them when their popularity became an existent threat, said Holly Vendova, FTC Bureau of Competition acting director. Apple and Google parent Alphabet were flat, while Microsoft rose 1%. Weakness in cyclical stocks, including energy, materials and financials, kept gains in the broader market in check as investors continue to fret about the economic outlook as the Delta variant of the coronavirus is expected to slow growth. Goldman Sachs cut its outlook on third quarter US GDP to 5.5% from 8.5%, citing the impact of the Delta variant of the coronavirus on the economy. The impact of the Delta variant on growth and inflation is proving to be somewhat larger than we expected, Goldman Sachs said in a rather understated way. The less robust forecast on the economic outlook comes as investors continue to digest the prospect of tightening from the Federal Reserve by the end of the year. And on the economic front, the labour market continued to show improvements as jobless claims hit a new pandemic-era low. New applications for US unemployment benefits fell in mid-August for the fourth week in a row and slipped to a 17-month low in a sign the economy is resisting the threat from the Delta variant of the coronavirus. Initial jobless claims in the States dropped by 29,000 to 348,000 in the week ended August the 14th. So it seems that even as Delta variants spread, businesses figure the US economy will weather the latest outbreak and keep growing. As a result, most companies are still trying to hire and to avoid layoffs, if possible, because of a nationwide shortage of labour. But the big question is whether more people will return to the labour force in the autumn, as expected when schools reopen and extra federal unemployment benefits run out. Federal Reserve officials, for instance, worry Delta could delay their return to work and prolong the labour shortage at least until the end of the year. New claims fell mostly in Texas, Michigan and Kentucky. The only states to see big increases were Virginia and New Mexico. An additional 109,379 people filed new claims for benefits through a temporary relief federal program. The number of people already collecting state jobless benefits, meanwhile, slid by 79,000 to a seasonally adjusted 2.82 million. Those so-called continuing claims are also at a pandemic-era low. Including federal benefits, 11.7 million people in the US were receiving some type of unemployment benefits in the week to July 31, down from 28.7 million a year earlier. That drop is a result in part of the increased number of people working and no longer receiving jobless aid, but it also reflects the cancellation in many states of a federal unemployment aid program for the self-employed and a separate program for the long-term jobless. That's also a new pandemic low. The number of people receiving compensation is expected to fall sharply in September once extra federal benefits for the unemployment benefit put in place during the pandemic expire. Total claims averaged less than 2 million a week before the viral outbreak. A healthy drop in unemployment claims is the latest evidence the rise of the Delta variant isn't having a significant effect on the economy, said corporate economist Robert Frick of Navy Federal Credit Union. We can infer that hiring remains strong in August, pointing to a healthy jobs report for this month. And the Biden administration said in a letter to lawmakers on Thursday that it's appropriate for expanded unemployment benefits to expire as scheduled in a little more than 2 weeks, but that states and local governments can use pandemic relief funds for added help beyond the deadline amid the surge of the Delta variant. There are some states where it may make sense for unemployed workers to continue to receive additional assistance for a longer period of time, allowing residents of those states more time to find a job in areas where unemployment remains high, Treasury Secretary Janet Yellen and Labour Secretary Marty Walsh wrote. The Delta variant may also pose short-term challenges to local economies and labour markets. In fact, the White House came under fire from Democratic leaders on Capitol Hill late last month when it requested that Congress pass an extension of an eviction moratorium just days before it expired. Congress didn't do so, and the White House couldn't put off the expiration unilaterally due to a Supreme Court ruling. Instead, the administration scrambled to write a new moratorium that covered fewer renters and homeowners. That crisis prompted questions about whether the administration would seek to extend other pandemic relief programs, but the White House has been reluctant to endorse a lengthening of a $300 weekly supplemental unemployment payment that passed the September the 6th end date. And the minutes from the Federal Reserve's July meeting showed most committee members believe the economy should be strong enough to meet the central bank's threshold to begin tapering its $120 billion monthly bond purchases. Most participants noted that provided the economy were to evolve broadly as they anticipated, they judge that it could be appropriate to start reducing the pace of asset purchases this month, the Fed's minutes showed. Now, here yesterday, the ABS reported that seasonally adjusted employment in Australia increased by 2,000 people between June and July, but hours worked fell by 0.2%. That was underpinned by large changes in New South Wales and Victoria. Those figures are, frankly, meaningless. Even the Treasurer seemed to agree. So this is just number wanging. The number of people on 0 hours from being stood down is 181,500, up from 156,500 and 58,200 in June and May, respectively. Real unemployment is around 6%, or actually more than 9% on alternative modelling from, say, Roy Morgan. So there really is no good news here. The ABS said the July data coincided with the early weeks of the Greater Sydney lockdown and increased restrictions in other parts of New South Wales, and also a series of changes in restrictions in other parts of the country. The labour market changes in New South Wales between June and July had a large influence on the national figures, they said. There were big falls in New South Wales in both employment, down 36,000, and unemployment down 27,000, with the labour force reducing by an additional 64,000 people. In addition, hours worked in New South Wales fell by 7%. These changes offset increases in employment and hours in Victoria. Before the pandemic, people in New South Wales accounted for 31.8% of national employment, and Victorians accounted for 26.5%. But large changes in these two states are important to understand changes in the overall Australian labour market. The national participation rate fell by 0.2 percentage points to 68%, and the unemployment rate by 0.3% to 4.6%. That was underpinned by a large drop in the New South Wales participation rate, down 1 percentage point, and a 0.6 percentage point fall in the state's unemployment rate. Early in the pandemic, we saw large falls in participation, which we've seen again in recent lockdowns. Beyond people losing their jobs, we've also seen unemployed people drop out of the labour force, the ABS said. In Victoria, we saw unemployment fall by 19,000 people in July 2020 during the second wave lockdown, and by 13,000 in the June 2021 lockdown. The fall in unemployment in New South Wales in July 2021 was more pronounced than either of these, falling by 27,000 people. In each of these instances, the unemployment rate also fell. Falls in unemployment and the unemployment rate may be counterintuitive given that they have coincided with falls in employment and hours, but it reflects the limited ability for people to actively look for work and be available for work during lockdowns. This means that people are falling out of the labour force. And there you have it. That's precisely the point. People are falling out of the labour force. In other words, they disappear off the ABS's radar. That is why this is a number wang. Around 61.5% of the fall in unemployment over June and July is explained by these falls in New South Wales and Victoria. The fall in the national unemployment rate in July should not necessarily be viewed as a sign of strengthening in the labour market, they said. It's another indication of the extent of reduced capacity for people to be active in the labour market in the states with the largest populations. As lockdown conditions ease, they say, we've seen participation increase. For example, the Victorian participation rate fell by 0.4 percentage points in June and recovered by 0.4 percentage points in July, prior to the start of the lockdown later in the month. Nationally, hours worked decreased by 0.2% from June to July and by 7% in New South Wales. In contrast, hours worked increased 9.7% in Victoria in July, following the 8.4% fall in June. Hours worked data continues to provide the best indicator of the extent of labour market impacts from lockdowns. In New South Wales, hours worked fell by 7% in July, compared with 0.9% fall in employment. This highlights the extent to which people in New South Wales had reduced hours or no work through the early stages of the lockdown without necessarily losing their jobs. An average weekly ordinary time earnings for full-time adults, according to the ABS, was $1,737 in May 21, up 1.5% from November 2020. The ABS said in May 2020, we saw a major compositional shock in the labour market, with low-paid jobs particularly affected by both job losses and government support. This led to a larger than usual increase in average weekly earnings at that time, which translated to a decline in average earnings in November 2020 as low-paid jobs returned. Since then, between November 2020 and May 21, average weekly earnings increased by 1.5% or $26, which was similar to the increases we saw before the pandemic, including a 1.8% increase or $29 in May 2009 and a 1.4% increase or $24 in November 2019. May 2021 average weekly earnings were for the week ending the 21st of May, at which point there were no lockdowns in place. And they went on to say that in original terms, Tasmania recorded the largest growth in the 6 months to May 2021 at 2.2%, but remained the lowest paid on average at $1,521 a week. The Northern Territory was the only state or territory to record a negative movement in average weekly earnings, declining by 0.5% to $1,695. The administrative and support service industries was one of the only two industries that recorded a negative 6-monthly movement, and the only one with an average that was still below its pre-pandemic level. The arts and recreation and construction industries had the largest 6-monthly growth in average earnings, rising by 5.4% and 4% respectively. And average weekly ordinary time earnings for full-time adult men grew by 1.8% to $1,837, which was higher than for women, up 0.9% to $1,575 for just the second time since 2014. This was partially explained by the high average earnings growth in the construction industry, which was, of course, populated by a high proportion of men. And Richard Holden, in the conversation, summed all of this up and said, this week provided a first tiny glimpse into the labour market fallout from Australia's recent lockdowns. Australian Bureau of Statistics published the wage price index for the June quarter yesterday, showing sluggish wages growth below forecasts. The labour force figures for July is an impressive 4.6%, but tempered by the number of people who have stopped looking for work and a higher unemployment rate. These numbers tell us how the labour market is recovering from last year's massive pandemic hit. It also is a sneak peek into how it might look to be affected by the current lockdowns. The Greater Sydney lockdown, which officially began on June 26th, ran at the end of the June quarter. Of course, the virus had been circulating in Sydney since mid-June. So the June quarter figures gives us a baseline for the labour market before the big hit from what looks like several months of lockdowns in Sydney, New South Wales and maybe beyond. And we also have a glimpse of the first 2 weeks of the self-lockdown in Sydney, where people pull back on economic activity due to the virus circulating. The wage price index measuring wages growth increased by 0.4% in the June quarter. That was below consensus forecast of 0.6% and put the annual rate at just 1.7%. Now that was just above the 2020 low of 1.4%. All that anecdotal chatter about how it's been impossible to get workers in this industry or that certainly didn't make its way into the aggregate data. There were sectorial differences in wage pressures. 3 sectors recorded annual increase in wages above 2%, construction at 2.2%, professional services at 2.5%, and other services at 2.6%. The smallest increase was in rental, hiring, and real estate services, which was just 1.1%. Administrative and support services at 1%, and arts and recreation services at 0.9%. And Thursday's labour force figures came on the back of a stunningly good June rate of 4.9%. July's rate is stunning again, kind of. The monthly unemployment rate dropped to 4.6%, represented 39,900 fewer unemployed persons, and a slight increase in employed persons by 2,200 to 30,156,400. But less positive was that the 4.6% rate also reflected a drop in labour force participation from 66.2 to 66%, and that the official underemployment rate jumped from 7.9% to 8.3%. The fuzzy demarcation between what makes one unemployed versus underemployed, as well as the effect of people leaving the labour market, is why Holden always focuses on all jobs figures in the total hours worked. This remained effectively steady in July at 1.778 billion hours. Overall, therefore, these figures represent very good news. Perhaps the most important implication is that all the naysayers who suggested we could never get unemployment down to or below 4% looks at least to be wrong so far. Speaking of folks being wrong, he said, the jobs data also bears on Reserve Bank Governor Philip Lowe's recent statements about the effect of immigration and wages. In a speech in early July, Lowe suggested high levels of immigration in recent years was an important reason for low wages growth. Others, including Holden, thinks this view is not supported by the data. Low wages growth since 2013 has a lot more to do with global shifts in technology, the phenomenon of secular stagnation, and the fact that the Reserve Bank kept interest rates too high for too long until finally giving into pressure to cut them in 2019. The latest data, if looking at the data is your thing, shows that with effectively zero immigration, wages growth remains low. It's barely moving, even in the sectors where immigration is meant to play the biggest role, such as services and construction. Moreover, even with unemployment falling to 4.6%, there's relatively little upward pressure. This suggests getting unemployment down to or below 4% not only might be achievable but necessary to get inflation back into the RBA's target band of 2 to 3%. That said, this might be the last good news for a while. The next quarter's figures will capture the effect of lockdowns for perhaps the entire 3 months in Greater Sydney, as well as a significant amount of time elsewhere. Fiscal support measures such as JobSaver and the disaster payment definitely helps, but they will only stem a flow of bad labour market numbers. But he says in the longer term, though, we can and should expect our policymakers, those thinking about fiscal and monetary, to show us an unemployment rate with a 3 in front of it in 2022 or 2023. But of course, as I keep saying, the official numbers really distort the truth, because to be employed, you only need to work 1 hour over a 2-week period. And you have to be actively looking for work. And we know at the moment there are many people working 0 hours. And we also know that there are many people not looking for work because there's no work out there. So the real unemployment rate is way, way higher than the number wagging. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.